Welcome to Grow Your Wealth, a series brought to you by BQ Prime and powered by Grow, the investing platform that's fast, easy, and transparent. Now, financial markets are something that's catching the attention of lots and lots of Indians, especially in the last few years. The aim of this series is to educate these investors on the basics of fundamental and technical analysis. These two tools are extremely important for viewers and investors to be able to invest their money in the stock markets and make the right decisions on buy, hold, or sell. So, keeping that in mind, today we'll be taking on board another very important topic in fundamental analysis, and that is how to build an investment portfolio. The building blocks of this process, which, by the way, is not a very static one. In fact, it is a dynamic one. To talk about this, I have with me Avinash Goraksha. He's a financial professional with extensive experience of more than 30 years. He started his career in 1992 and has since then worked with several financial services companies. He currently is the head of research with Profit Mart Securities. Avinash, thank you so much for joining us today on Grow Your Wealth.
Yeah, thank you, Mubina.
Well, Avinash, I think for someone who has not yet started their investment journey, building the investment portfolio, that's taking that first step is extremely crucial. How do you propose they kickstart their journey? What is step one in building an investment portfolio?
See, I think, Mubina, the first step in building the investment portfolio is, first of all, start the investment journey by opening a online trading and demat account, and preferably with an online, company like Grow. I think the services are pretty solid and quick. After the account is opened, I think the first step which a new investor should do is that I think he should start looking at investing in the index funds. Index funds are basically funds which deal with the Nifty and with sectoral indices, which is a very easy way to get into the markets. And secondly, for an investor who's new to the capital market, my suggestion is that he should start his journey by looking at mutual funds. Either he can go for growth funds, he can go for dividend or value and growth funds combined. But most importantly, he should start his journey at a younger age, because the younger a person, then obviously the investment corpus and the investment journey will deliver solid compounding returns over the longer term. And most importantly, as a person gains maturity in the markets and time in the markets and he's more confident, then I think he can slowly move on to direct equities. He can start building a portfolio by doing an SIP, by getting into frontline companies from the large caps, from the blue chip kind of companies, and typically ensure that this becomes a solid kind of investment base over the next, say, 5 to 10 years. Typically, equity is an asset class which compounds wealth over the next 5 to 10 years comfortably, and historically it has been proven that equity has beaten inflation hands down. So clearly, I think for a new investor, this would be the advice, that he should plan his investment in a very proper manner. Start early to invest, and invest initially in the index funds and then on the direct equity investments route, and obviously keep a reasonably large kitty even on the mutual fund side, which will help you actually ensure that by the time a period of 5 to 10 years happens, you will have another source of income which will actually contribute to your total income, which is going to be the most important aspect of investment. So investments made early would obviously reap rich rewards in the longer term. So these are the steps which primarily a new investor who starts his journey should take, and definitely if he does that, he should benefit quite significantly over a longer period of time.
Well, apart from capital appreciation, the other extremely important factor when it comes to building an investment portfolio, of course, is generating that passive income as well. So, Avinash, what are the must-have products in an investment portfolio?
As I told you, the must-have investment portfolio should have an index mutual fund. You must have an index mutual fund portfolio, portfolio in your overall investment basket. And the second is you must have a direct, exposure to equity. Typically, Mubina, if somebody starts investing at around, say, 20, 22 years, my suggestion is that since he's young, he does not have any major responsibilities with him at that kind of age. At least for the next 20 years, he should only focus on equity, either through the mutual fund route or direct equities, depending on his risk appetite. And after a 20-year period, then he could possibly broad-base his asset portfolio. He could look at other asset classes like, debt, or he could look at gold or real estate. More importantly, equity will always remain a promising asset because it's a liquid asset. You can sell off and you can obviously liquidate your assets without any problems. So I would suggest that the must should be obviously a mutual fund index portfolio, a direct equity exposure, And then going forward, as your portfolio matures, it becomes big, then try to diversify into other asset classes like gold, real estate, or, gold, which can be available through via ETFs, which are very easily available and where, the transaction cost also is minimal. So I think this should be the process where an investor should follow. And I think it should be a journey, which I think should be done slowly and gradually, not anything in a hurry. But obviously, if it is done early, then I think the benefits would obviously be quite significant.
Well, yes, the earlier you start your investing journey, the better you're able to reap the benefits of, as we call, the power of compounding. Avinash, you mentioned equities, you mentioned index funds, you even mentioned gold and debt. So my question is, what's the ratio that one should invest their investable funds in all of these products?
Mobina, I think the most important thing when you decide your ratio of, typically exposure to all these asset classes depends on 2, 3 important factors. One is basically, what is the age of the investor? If a young investor is there, then obviously equity is the first asset class to be preferred. Second is what is the kind of timeline, the investor has in mind. Does he have a 5-year timeline, or does he have a 15-year timeline, or a 20-year timeline? So that is very important when you want to decide the ratio of investments across asset classes. And finally, what's the risk appetite? Like, there are many investors who are unable to accept market volatility on a daily basis. They prefer to be very safe. They want to have steady returns, no risk in the markets. So typically, when you talk about these 3 factors, then I think you have to decide, if you have the risk appetite, if you are a younger investor, if your timeline is pretty large, then equity is definitely the preferable asset class. But I think somebody who's above 35 or 40 years and is reasonably, having a lot of responsibilities with him, a lot of liabilities on his side, for such kind of investors, I think the debt fund route, the FMP route, via a SIP method is always going to be good. And another aspect is you should build a passive income very cleverly. Passive incomes obviously play off over a longer period of time. So I think through the mutual fund route and through buying, good companies which give rich dividends, you must be seeing a lot of companies generate a huge amount of dividends for their shareholders. So many companies have got the benefit of giving dividends. So obviously, if investors can build a portfolio of such high dividend paying companies, that could also be a strategy used by slightly older and matured investors who can obviously enjoy this kind of passive income, for a very long period of time. So I think these could be the ways in which, both the younger as well as the older investors, depending on their risk appetite and depending upon their timeline, could possibly use these strategies and obviously get the benefits of, all the asset classes in a very balanced manner.
Now, Avinash, we've been talking about how, building an investment portfolio is a process that should start off preferably when you are younger. When you are younger, you're bound to make certain mistakes. In your experience, Avinash, what are the most common mistakes people make when building their investment portfolio?
See, I think, Mobina, the most common mistake is today younger investors, want to always compare their returns with other investors, with their friends, with their relatives. So they get disappointed when they see that their portfolios are not doing well. And second important aspect which is seen now is that most of the smaller retail investors try to, look at what the celebrity investors do, what a Rakesh Jhunjhunwala buys, or maybe a Ramesh Damani buys, and blindly buy the stock at any price. Unfortunately, this results in basically getting stuck into companies at high valuations. And this is one of the things which needs to be avoided. Although one definitely says that you have to follow these guys very closely, but don't copy them completely. And the third important thing is, the fact which is very evident in today's markets is that retail investors just love penny stocks. A stock which is quoting at 5 rupees, 2 rupees, is something which investors just love to buy. I think classic examples have been many companies, which have gone down the, street. So clearly, if you're buying a penny stock, you should know what is the risk involved. And obviously, look at the upside, considering that the company which you're buying is not a good company, because penny stocks typically are those stocks where the company is incurring a loss or there's a problem with the sector or with the company. The other thing which is very important, Mobina, is that a lot of people nowadays go for margin financing, which is a method by which you borrow money from the broker and then deploy it in the market. Basically, that is one thing which needs to be strictly avoided. And finally, as an investor, you should believe in data. Please don't believe in market rumors, and only believe in the concept of logic on the basis of that data. Because without data in the market, you will never be able to make money. So I think read about the company properly, do your own homework, and only then, after doing all the homework, you can go and invest your money for the longer term.
Well, those are the golden principles that Avinash recommends all investors follow. But most importantly, starting early is something that really will work in your benefit. Avinash, thank you so much for joining in on this episode of Grow Your Wealth. With that, we'll call it a day. Thank you so much for tuning in.